Jean Gruss, let's go to you with story number 4. Jean Gruss, this piece is coming out of Bloomberg. I'm going to read you the headline first couple graphs, and I want you to comment. Headline: Bond traders are preparing for a 5% yield. No rate cut world. And here's first couple graphs. Bond traders are readying for 10-year U.S. Treasury yields surpassing 5% as a scenario of no interest rate cuts by the Federal Reserve this year looks increasingly possible. And to give everybody context, going into 2024, there was talk that we could have as many as 6 rate cuts. Now they're talking about 2 or 3 rate cuts. And this story is indicating we might actually see rates going up. So story goes on to say Schroders PLC is shorting U.S. bonds across some tenors as sticky inflation raises the risk of higher for longer rates. Pacific Investment Management Company expects the Fed to ease policy at a more gradual pace than peers in other developed markets, with a non-negligible chance that it doesn't cut at all. Jean, what's going on? Everybody thinks the stock market is what drives the world. It's actually the bonds that drive the world. So what's your take on it as a former banking reporter?
Yeah, and we were just talking about this on last week's episode, that the Federal Reserve is just they don't seem to know what they're doing. I mean, we went from like 7 cuts to none in like a matter of like a couple months. I mean, how does that happen? They haven't licked inflation like they thought they would, and yields are going to remain high, and I think that's going to cause some pain going forward, particularly in the commercial real estate market, as investors have to renew their loans, and that's going to create some real hardships, I think. But yeah, the thing is that the bond market reacts to what the Fed says, and the Fed has been sending mixed messages, and they've been stampeding in and out of the 10-year bond like crazy. I mean, the 10-year bond, 10-year Treasury bond is sort of the benchmark rate for so many of our financial products, and so many of our mortgages related to real estate, commercial and residential. You just can't mess around with it, and these wild swings in a 10-year bond it's really creating a lot of chaos in the market. And the outlook earlier this year that we would be getting a bunch of rate cuts, is really and now we're not going to get any. Maybe, I mean, that's screwing everybody's plans. You just I think it's really irresponsible to be sort of creating this chaos in the bond market, these wild swings of investors piling in and piling out, of treasuries. It's really amazing. I don't think I've seen it in like 30 years I've been covering finance. This kind of volatility is really, it's going to create some real problems, I think.
No, Mr. Gruss, just to lay it out for the audience, people who don't really give rat's ass too much about it, but so we can put it in their terms. Basically, the 10-year Treasury, a bank will put like 3 points on it for a mortgage. Is that fair? So if it's coming in at 5, then
right,
your mortgage would be 8.
Exactly.
Ballpark. Okay.
Yeah.
And then generally speaking, when the Federal Reserve, the central bank, when it cuts interest rates, housing tends to go up because stuff's cheaper. And when it raises interest rates, housing tends to slow down because everything costs more. Am I getting that right, Mr. Gruss?
Yeah, I think you can say that.
Okay, so if we're looking at a 10-year Treasury approaching 5, today when we're recording, it's coming in at 4.6. That means rates are going up. So that would, in theory, mean this could be bad for housing.
I mean, we could go back to 8% or more mortgages. I mean, we're at 7.5 now on average. 8 is not that far away. Of course, we had 8 last year.
We did.
So we did see, could go higher. I mean, I think we talked on the podcast last week. JP Morgan was talking about 8%, 8% rates. And so, yeah, we, it's anybody's guess right now.
Katherine, you're the residential bureau chief over at The Real Deal. Have you heard anything from any of your sources or reporting out stories? What impact are people? Are they concerned that mortgage rates could hit 8% if the 10-year Treasury actually hits 5? Any thoughts?
Not really. I mean, a lot of my sources are real estate agents, and they don't talk about that. So maybe they probably are concerned.
They probably are concerned. Interesting.